seminars are something which Century had done a lot. Before 2020, we used to do continue seminars, and that was something which became a part of our entire expertise. And post 2020, obviously, a lot of things changed. People got really familiar with a webinar setup. They got familiar with the technology. They loved to talk over Zoom, talking of which we are doing a Zoom session as well as I speak live. So we have people who have joined over the Zoom link also. And before coming here, I literally went to the consultant hub and I asked them that I have a lot of people who have come today and a lot of them have joined over Zoom as well. So which are the products you want me to talk about? So I have my set of products which I can definitely talk about, but before I came here, I asked them that if there is something they're willing me to put forward, because what happens, we as investors, we really become familiar to the idea of investing in that one asset class. Like, I'm sure there are a lot of people who feel real estate is something which I want to invest in, or stocks is something which I'm really good at, or bonds are something which we are really good at. But the point is, the key is, you have to invest in different places. So how many times we hear this phrase, right, that I don't invest in something which I'm not really aware about. We make this notion, but the reality is that we need to invest even in things which we are not aware about, because we don't know their potential. We need to identify their risk, we need to identify their return. And after doing that, if we really feel that, no, this is not my cup of tea, why not? But we really need to be aware and informed. So this session is about that. And I see the people who are here, I really want to ask you, I'm sure you have a certain expectation from this session. Some of you must be trading or investing. So before I even put anything out there, I really want to know, what is that thing which you feel should definitely be answered? It could be any concept, it could be fundamental or technical, it could be about markets, about trading, about anything, if you have any questions in mind. And I can always come back to you also if you have not thought anything specific about. But if you have something in mind which you really, really want me to cover apart from what I have to do, I'm just going to put it on the board so I do not forget. Sir?
Minimum risk, high profit.
Minimum risk, high profit. I think he spoke everybody's mind. How to make more profit with minimum risk. Classic master. Risk management. Okay, perfect. How we are managing risk. Put it out there. Sir? CFD trading. So what we need to consider while we are trading CFDs, because CFDs provide leverage, the infamous leverage, which is responsible for a lot of accounts when they close out, when they make a loss, but it's also responsible for a lot of profits. So we need to understand what are the factors. So anything?
When to enter, when to exit.
When to enter, when to exit. Entry and exit. Very close to the fact, sir said. More profit, less risk. Sir.
You have the cryptocurrency that is coming up.
Yeah.
It's not regulated by the Fed.
Correct.
I think we have Trump's daughter coming up for coin. So how do you manage that in the compliance angle?
Trump coin. I know your questions about cryptocurrency, but I'm sure Trump coin, when we talk about, and we're definitely going to talk about the regulation part, that how to trade in it, because crypto as a CFD and crypto as a wallet investment is something which is really important. So you were saying on 10-year treasuries. So we are looking at US bonds as well, and get 10-year bonds. Looking at investment grade bonds, definitely. So, any other thing you want me to put it on the board? Or even if it comes across your mind, definitely tell me, because these are the questions which I definitely want to answer, because this is something which you're looking forward to know. So, 2024 was, from an investment perspective in stocks or commodities, it was kind of a very good year. I mean, the volatility is definitely a part of opportunity. So it happens a lot of times that when we see markets moving a lot. We feel that is it really safe, this much amount of movement? But the reality is, the problem is when they're not moving, because as an investor, as a trader, you are not really sure where the direction, it's just one-sided. So is it really a uptrend or is it really a bubble? And that's what worries us. Now, the point of volatility is about not just moving up or down, it's the rate at which markets move. So if were to tell you in 2013, if I see gold moving up by $40 in one day, there has to be something pushing it. It was a event. It was a day we would talk about for another 1 week that, gold went up by $40. This happened. It was the news. These days, I go to bed, I get up in the morning and I see it has already moved. Asia opened, gold moved $40 up, it's already $40 down. Volatility has increased. Technology transformed. A lot of things happened in last 10, 15 years. Fortunately, I witnessed 4 years of Barack Obama, 4 years of Trump, 4 years of Biden, and then again looking at 4 years of Donald Trump. So US elections is one of those things that every time a president changes, the investment changes, your portfolio also changes accordingly. So if we see from a 2024 perspective, if you see how US stock markets have performed, so a very common question, I think so you asked, minimum risk, more profit. Profit is a word which publicly I never use for legal purposes also. But the idea is everybody wants gain in their investment. If you're not a trader, if you don't like to trade every day, even if you do nothing in terms of trading, if you just take your money and put it into a US stock market index or a fund which is tracking the performance of that index, yearly basis, so 2024, we saw NASDAQ, which tracks the performance of tech companies in US, 100 tech companies, it moved up by 28%. S&P 500 went up by 23%. Dow Jones went up by 12%. So S&P 500 is a US benchmark. US benchmark means that if you want to invest in the stock market of US, you could buy the index and your exposure will be into 500 companies. And these 500 companies are the ones which we are really aware about. I'm talking the likes of Apples and Microsofts and Boeing and 500 companies like this. Is this something which happens every year? Obviously, no. We have seen some really bad years. 2022, NASDAQ fell down by more than 45%. But in 2023, NASDAQ was up by 55%. Now, all of this yearly return, so even if you don't trade every day and if you invest into these funds, this is what we saw in 2024. On an average, since 1970s, if we see S&P 500 till date, on an average, 11 to 12% increase we have observed year on year. Now that could include some very bad years where it goes down by 25-30% also. It could include some good years like this where you are looking at a positive market. This was US. If we change to Europe, you will see DAX, which is a German stock market index, up by 18%. European stock 600, which includes 600 European companies on an average, up by 5.9%. French index down by 2.1%. So Europe had a tough time, and Europe had a very tough year also, because when inflation was increasing in US and Europe, both the central banks increased the interest rates together, US, Europe, and UK itself. But when US continued to increase and Europe also continued to increase, Germany went into recession. And that was the reason why Europe stopped increasing interest rates, because they were scared that if Germany falls further into recession, that is the best economy with best manufacturing in Europe. So we saw some really tough times for Germany, but we still see that in spite of Germany being into recession, 2024, the German index showed 18% growth. Is this normal? If I tell you that a country is into recession, you would expect the stock market to go down. Why German as an index continue to move higher in 2024? So one of the reasons was that central bank decided to keep the interest rates lower, which means they're not going to make loans more expensive. But second thing was a lot of companies which are in the German index, they get their profits from US. So while US continue to prosper, the German index also continue to go higher. So this is something for you to just remember this, that every time when you are looking at an index, we will feel that, okay, this country is in recession, so the index should fall, and that's logical. But sometimes something like this would happen and your trade would go completely wrong. I'm telling you this because mine went wrong. And then I did more research and found out that why it happened, because all these years I've been following German index. It tracks the economy, it goes accordingly. But this time, the reason I found out that a lot of these companies have started getting their profits from US. US economy was going well, and that is why the German index continued to prosper. So that was something which we need to understand also, that in an index, the companies which are in it, where their profits are coming from. And that is the reason why the moment Trump became the president, one index which tracks the performance of smaller market value companies, which is also called the small cap index, it shot up 5-6% in one day. And before that, it has been going up 10%, 11%, because the idea was that every single time a Republican like Donald Trump has become the president, the smaller market value companies have moved up. And there are reasons behind it. Now, Trump has talked about tariffs, right? Putting tariffs on China, Canada, Mexico, every single country you can think of. So what happens to the companies which are within US? The idea is this is a very protectionist policy, right? Why presidents put tariffs? He's not the first one to do it, by the way. Obama did, Clinton did, George Bush did. But the whole idea of doing this was that encouraging the participation from the domestic companies, right? If you put a higher tax on steel or aluminum for the importer, so they cannot import this, now they have to buy from the regional domestic companies. Now, if the domestic companies have the capacity to produce at that rate, the stocks would move higher. That was the idea why small cap index started going up. So if you have not looked at the small cap index so far, I mean, last 1 week, we have seen the small caps falling down a lot. So what I'm telling you right now, if you see last 1 week, it has been a complete fall for the markets. A lot of events have happened. So earlier, Trump put tariffs on Canada, then delayed it. And then he said that we are not postponing it. And this is something which is going to be into effect. So this is what 2016 was. Every time he would put a tariff, stock market would fall. And then a tweet would come out of Donald Trump, and that would say that we had a great trade deal with China and everything is going to be really good, and the stock markets would go up. And then Chinese officials would tweet back that there has been no such deal, and then markets would fall down again. Why I'm telling you this, because while you are planning your trade on the basis of logic and rationality, there's one person out there who's going to spill water on your entire logic. That is why you need to diversify. Because today, if you are buying dollar or buying gold or crude oil thinking that this is the right thing to do because of this fundamental reason, anything can happen right now. Somebody who said we are going to postpone the tariffs, markets went up. Now he said we are not going to postpone the tariffs, markets went down. Nobody could prepare you for that kind of, even we will not be prepared for this kind of. So the only way here is to diversify, to know more about the product. So that's why I'm showing you that while US market, European market, and then looking at Asian benchmarks, we are looking at Japanese index, which went up by 19%. We're looking at Taiwan exchange 30%, Hang Seng, which is China, 17%, Shanghai, and then South Korea, which fell down by 9.6%. These three economies are very different. So while there is a pattern, Europe, UK follows US a lot. We have seen sometimes that US markets are going up, German is also going up, UK is also going up. Asia is different. Hong Kong, very different. So if you really would want to diversify between two markets, pick US and Asia separately. That would give you a very, so right now, in last 1 week, while the US markets have fallen down a lot, we have seen Asian markets, especially China, moving higher. And the reason is that they are talking about injecting more cash into their economy. because China is going through deflation while the entire world has faced inflation in the last 2 years. So for China, it is really important to inject more and more cash so consumer spending can increase and eventually the prices could go up. And that is the idea why the Hong Kong index has moved higher. So we'll go through the live platform also and try to see that how last 1 week, 10 days have been for these crucial products. And then we'll understand that. So this was Middle East. How many of you have invested into UAE stocks? Okay. Anyone else? Okay. Go ahead, Prashant. Was that back in 2008?
Just one Lulu gone down.
Okay. Okay. But see, so just to give you an idea, right now, Middle Eastern markets, they're getting more open to IPOs as compared to before. So I see a lot of brokers are trying to list UAE stocks as well. I think this is something which is at the stage of getting more mature. So if you're doing that, I think it's one of the key diversified sectors. So do not get discouraged after doing it, because see, there are a lot of companies which will give you fixed income, like in a form of dividend. So if nothing else, you could invest in these companies for that, especially companies like DIVA or SALIC. These are as good as government bonds, if I were to put it. They are giving you a fixed income and the volatility is not something which is too high. So what is moving the market? Now, this is the very important question. So now when you're placing your trades, or when you're even thinking about long-term investing, there are going to be some factors which you will be looking at. One of them, interest rate and central bank policies. The most important is the interest rate decisions, because markets move up or down because of inflation. And it's really that simple. I mean, it's so if inflation is high, so what central bank is thinking, inflation is high, prices are going up. Prices are going up because demand is higher. Demand is higher because people are spending more. People are spending more because they have more money in their pockets. One of the reasons could be that loans are cheaper, credit is cheaper, so companies are borrowing more money. So what they do, they make loans expensive, which is basically the rate hike. When they're making loans more expensive, companies are borrowing less money. When they are borrowing less money, the spending is less, demand is less, and eventually the price falls. So the idea is that every single time when a central bank meeting happens, especially, so when I say central bank, we'll be talking more about US central bank, because the highest volatility which we have seen is in the US markets. Whether you talk about gold or dollar or any stock market index, US has highest number of buyers and sellers. The liquidity is really high. The largest bond market also, by the way, it is in UK. But if you see the liquidity, the highest it is in US. So we'll be talking more about US centric to get the idea that if I'm talking about inflation numbers, I'm talking about US inflation to be specific. Now, 2024 was the year where central banks, they made loans cheaper, because a year before that and a year before that, we saw inflation going really high. So they had to make loans expensive, which brought inflation down. And then the investors, imagine in 2020, you could borrow money at an interest rate of 0.25% or 1%. All of a sudden, that interest rate becomes 5.5%. What will happen to the businesses? They're discouraged, right? So what happens to the stock markets? Falls down. That's what happened in 2022. In 2023, inflation started getting under control. And in 2024, we saw a series of rate cuts, which pushed stock markets higher. So that was the main reason why you have seen US and European markets also getting that kick. But what also happened in 2024, Donald Trump happened in 2024. Became US president, started talking about tariffs. And so tariffs means that there is going to be a trade war, right? You put tariffs on China today, Canada today, they are going to retaliate with the tariffs of their own. This will hamper the global trade together, which means the prices of products become more expensive due to lack of supply. That means inflation increases again due to less supply and higher demand. The same inflation which US and other countries have been fighting in 2022 for so hard. So central banks will think, why should I make loans cheaper if I am in fear of inflation? Let's keep the interest rates same. Interest rates same, not coming down, stocks and companies, they get worried. So that is why we see that every time a central bank meeting happens and the decision comes out that we are going to keep the interest rates same, we are not going to change it, stock market falls. Dollar becomes more stronger. And a lot of times, if you see these central bank meetings, some people try to trade during the meetings. Personally, what I've experienced is it is always good that once the dust gets settled after 12 o'clock, because 11:30 is when the press conference begins, by 12 o'clock the dust settles, then or the next day you should place your trades, because while the Fed chairperson is talking, there's a lot of movement in the market. You will see if you're putting a stop loss, it might just get hit because the markets are moving in both directions because there is no clarity. Same goes for trading when you do in jobs reports or inflation numbers. You will see heightened volatility in those 5 minutes, 10 minutes. If you're on the right side of the trade, you win. But if you're on the wrong side of the trade, then you lose. So the idea is always to wait for the news to come. And if the news is really important, the impact of that could be observed. So macroeconomic factors, interest rate decisions, it really moves the market. Whenever this meeting is happening, you really, if you're a trader, see, if you're a long-term investor, I'm sure a lot of you just buy and hold, which is an amazing thing. It's a Warren Buffett way of making money, right? I think there is no contest. If someone asks me that where you can make more money in trading or investing, how many of you trade? If I can take a poll, okay, 2, 3, 4, 5. How many of you are investing? Just buy and hold. Perfect. So those who invest in a longer period of time, if I had to close my eyes and think that who's going to make more money, it's basically the investors. Not saying traders will lose. The only thing is, you're a trader, you have raised your hand, so you know what I'm talking about. Trading is, it requires a discipline. So you have to ask yourself a question that, are you a trader or you are a disciplined trader? Because disciplined trader means that you have to accept the losses, day ended, trade ended, the next day, a new day, a new trend. I've seen people making money from trading day on day, but they are very disciplined people. If you're a kind of person who holds uh, the trade which was supposed to be closed in one day, but because it did not go in your favor, now you're holding it for a long term, saying that I'm a long-term investor, then you are not a disciplined trader. They always say a long-term trade is a short-term trade gone wrong. And we have all gone through this phase, right? So we have to understand that whenever there is a big news coming in for day traders, this is the most important news which you can have. Second is geopolitical events, the trade wars, sanctions, global conflicts. One product which goes up during these things, gold. Gold from 2024 till now, it has gone up more than 35%. And it has been an upside cycle. The prices have skyrocketed, and we have seen something which was at $2,000 in 2024 is now very close to 3,000 in the beginning of 2025. So anyone who had bought gold ETFs or took exposure in the commodity would have made money, and well done. If you're thinking right now what to do with gold, to give you an understanding, the analysis is still very upsided, very positive, because the geopolitical tensions seems to be unfortunately here to stay. I mean, there are discussions on Russia-Ukraine issues every day, but with Trump talking about tariffs, so this happened in 2018 when trade tariffs came into the picture, gold prices skyrocketed. Which is one metal that follows gold in the same direction? Silver. In 2018, when trade tariffs came across, silver prices fell because silver has a more of industrial application. Gold is more like a safe haven. So when people get panicked, they buy more gold. They don't buy silver. If there is a manufacturing slowdown, silver prices would normally fall. So what we have observed in the previous trade war was that gold prices went up, silver went down. We have seen gold prices even during this trade war have been going higher. But this time, not just because of the uncertainty. Gold prices have gone up because central banks have purchased gold. The physical gold has been purchased a lot. Geopolitical issues. And at the same time, in 2024, we saw central banks cutting interest rates. US elections, uncertainty, everything contributed gold prices going higher. The analyst recommendation still 3,000 and above. Day on day basis, the trend still looks very bullish. But for day traders, I would never suggest you to put a trade without a stop loss because gold easily moves these days $30, $35 a day. So a good part about this is that you don't really have to increase your quantities too much. You can just keep a very minimal quantity and you will still be able to experience a good volatility in that product. About the stocks, one specific factor that why stocks, individual stocks could move up, earnings. Earnings season comes every 3 months. So we have seen this December or Jan, Feb, we have seen in April, May, we have seen in July, August, we have seen October, November. And that is the best time to trade the stock. Stocks move more than 10, 15% up or down both ways during earnings season when the results come out. Results, they come out in the form of earning per share. Those results are compared with what is expected out of that company. And if the results are really good, you will see stocks moving the very same time. Netflix came up with good financial results after the stock market closed. The price was 850. Next day, it opened at 994. $150 up. After that, I bought 5 shares. Before. When I was talking to somebody, he said, do you think it's good? I said, yeah, it feels like good, 5 shares. That guy bought 50. Didn't tell me. My own colleague. We are not friends anymore. But this is the kind of movement you can get in stocks. But same, obviously, you have to manage your quantities because if the earnings are not good, stock prices could fall also in that direction. So you have to understand if you are really a kind of person who would like to buy stocks day in, day out, pick those months. So we have something called a strategy called price action analysis, where we go through the earnings of these companies for last 10 years. And we see that after the earnings in last 10 years, on an average, how much the stock has moved up or down, how much volatile it is. And then we calculate the probability of an up move. And then we tell you that if you buy the stock and hold on to it for a day, for a week, for a month, how much percentage increase or decrease you can expect. So this is something which is not available on Google. This is where the research part comes into. So wherever you are trading, wherever you are investing, strategies really work. Strategy is something which you must have. Diversification is one of those strategies, right? That we spread our risk into different directions. We always hear that don't put all your eggs in one basket. The idea is why? Because if you're concentrated on one product, like cryptocurrencies, it started a trend, right? After elections, Bitcoin, which was 60,000, went to 70, 80, 90, 110 also. It was very hard to imagine that Bitcoin can fall. Here it is at 88,000, 89,000, right? We are anxious about it. We are really anxious about it because in last few months, it did not break 90,000. Now it is 87, 88. We are worried that we go to sleep, we get up in the morning, it could be 70, 72. So now we are worried about it. But then we need to strategize. We can look at Solana, we can look at Ethereum, something which is lower denomination, more sustainable than Bitcoin is, and we can create a kind of pair trade. So these are the kind of strategies. Riskiest of the products can be traded with minimum risk, but you have to strategize it. Even something like cryptocurrency. So the first question which you asked, how to take minimum risk, more profit, right? So the only way you can take a minimum risk is by spreading it into different directions. Because this is one thing we grew up as a community where we realized high risk means loss, right? Don't take too much risk, might lose money. High risk does not mean loss. High risk, because risk is something which is a term which is calculated, budgeted, monitored, right? They always say take calculated risk. High risk, whenever in an investment, when I tell you this investment is high risk, I must assume that you have calculated that how much risk you are willing, how much money you're willing to put. if you have money which is supposed to be for your child's education and you put it into Bitcoin, that risk is not managed well, right? But if 1% of your net worth is into cryptocurrency, you're investing into a high risk product, your risk is still managed. So one way to take minimum risk first is diversify different products. Second, always assess the risk appetite of a product. So look at this really cool pyramid right here. This is where your savings account are, your emergency fund, your fixed deposits right here. This is the money which you have kept aside. This is your go-to bag. You need this cash at any point of time. You need to leave the country urgently. You should be able to get this, right? You do not really care about how much money you are going to earn. You do not really care about how much interest you are going to earn. This money is kept here because you feel it is more liquid, it is very safe. So this is one. Once this is done, you move on further, you start putting money into bonds, right? Something which is giving you fixed income. Then you move further, you start investing into mutual funds, into real estate, into blue chip stocks, like good stocks, right? And then finally you reach here. You are trading right here. Tip of this pyramid, right? Tip of this pyramid, this is where the trading lies. I went to American University of Dubai. We had to conduct a session for the students. So I asked them, how many of you invest? Nobody answered the question. How many of you trade? A lot of hands went. So I asked a student, well, what do you trade in? So Bitcoin, Ripple. So do you have a job? No. So I'm no one to judge. This generation is very different. And when I said this generation, I'm 35, they're 25, but there's a big gap between that, right? They have learned something different. But the point is that old school, we follow this. This is the investment pyramid which we must follow. If I have not invested into products which are giving me fixed income, I cannot take all my money and put into trading. This is something which we need to learn right away. If you do not have, what did pandemic taught us? Emergency fund. Yeah, I'm not going to ask the question that how many of you have an emergency fund, but I know you understand the concept. Whatever is your monthly expenses, multiplied by 12. That if you don't have a job for 12 months, or if you were forced to lock yourself inside the door due to a virus, you should be able to sustain, right? You should be able to get back to your feet once this is over. That emergency fund was not a concept before. Now it is. So the minimizing of risk starts from this pyramid, where your money is invested into real estate also. How many of you love real estate, invest in real estate? Everybody. Those who are not raising hands don't want to tell. That's okay. I respect that. But the point is, why you love real estate? Reasons. You always feel real estate prices always going to move higher. It's the best hedge for inflation, right? Then you can revenue, you can put it on rent, get a rental income. Isn't that the dream? Buy 4 houses here, eventually pay off the loans, get the rental income, retire here, you're so happy. Want to do it. I also want to do it. The point is, real estate, good hedge for inflation. Not liquid though. You buy a house today, you want to sell it tomorrow, you cannot. But it's a good investment. So you should have it in your portfolio along with investments which are liquid also, stocks. If you see 2013, and back me up, I could be wrong in this, so you tell me, wasn't between 2012 to 2018 or 2019, I think before 2020 happened, the real estate was very stagnant back then, right? And I don't think the prices went too high. So somebody had bought something to 2012 until 2018 or 19, we did not really see the prices appreciating, right? But between 2012 to 2019, what happened to Amazon or Apple? It went up by 500%, right? So if you had put all your money into real estate for those 5 years, it's not yielding any return. If you divide half of that, put into some stocks, they're giving you more returns, which covers your loss in real estate also. Diversification. It does, I'm sure this is not a new concept to you, but the thing is, when I say this out loud, you will realize that a lot of you are not following this because either you're not aware about that product and sometimes you feel that it is too risky. But the thing is, high risk, does not mean a loss. High risk means you just need to provide a smaller portion of your investment. Think about areas which we always felt were high risk. So I'm going to talk about, look at this. These are some themes which I'm putting it into 2025, but to be true to you, even in 2023, 2024, now AI is talked more about. Chat GPTs and DeepSeeks and OpenAIs and all of that. But isn't AI something which has been talked about a lot before? Even the time we had made fun of it, right? Every time people used to talk about robots, we used to think about Terminator becoming a robot, coming into our lives, right? We used to laugh on this idea. What is going to happen? Pandemic pushed the world into technological advancement. If I would send my Zoom link to my father before 2020, he would say, what is this nonsense? Call me. Can't talk to you on Zoom. What is this? I can't operate. Post 2020, now my father sending me, if you can't talk, just come Google Meet, come on Teams, come on Zoom. And what is this upgrade all of a sudden he got? Because people got used to this idea, right? Right now I'm talking, there are people on Zoom which are already online. So now we have progressed. That is the reason why AI innovation is becoming very important. So we are talking about the areas, cloud computing, cybersecurity, semiconductors, cybersecurity. I've talked about cybersecurity for last 3 years. What happened last 1 week, if you must have heard, the BitBuy, there was a big hack, $1.5 billion worth cryptocurrency stolen. It was stolen from a cold wallet, which was supposed to be preventing this to happen, right? $1.5 billion. Tell me one thing. If today, every single thing which you have is not digital, from your MX IDs to your online bankings, to your Instagrams, to your WhatsApps, to your work emails, even your own pictures, which Apple very handsomely charges for the cloud memory. If you click too many pictures, you would know, because you're paying extra to keep that in Google and in iPhone. Imagine this, every single thing today we talk about it digitalized. We are talking about this. Hopefully, when I open my Instagram, I will have an advert on what we have just discussed about, right? They're listening us. Don't you think that there's a major risk of identity theft, corporate espionage, ransomware, malwares? Do you know there are companies which are spending billions year on year to protect these things? Cybersecurity, companies like Palo Alto, Zscaler, Okta. Now you ask yourself, have you invested in cybersecurity in any stock? Anyone has? You have invested in 2 stocks, could be in Indian markets, UAE markets, back in Pakistan, back in everywhere, back in Dubai or US. But have you invested in cybersecurity? I'm not. Last 3 years, these companies have been moving higher and higher. Why? Because the risk. So what happens when digitalization increases? Even the hackers also become smart, right? What do you think? Your cute password, which you have put on Google, which is followed by 3 secret questions. One of them is our mother's name. One of them is the school we went to. And one of them is the place where we got married, right? If I got even one of this right, you see what I'm talking about. The cybersecurity is not this. Cybersecurity requires much more tough. If you have a crypto wallet, trust me, you are still vulnerable that being stolen. Now, maybe the amount is not big enough, but whatever it means to you, that is always a risk. So if that happens to you, what is your plan B? So at least keep a part of your investments. Now, cybersecurity, by the way, cybersecurity is tech. Anything which is tech, it's always come into riskier. Why? Because tech companies, what is the difference between a utility company and a tech company? So utility companies are called value stocks. Tech companies are called growth stocks. Value companies like utility, which is coal power, energy, you talk about companies which are into food and beverages, groceries, supermarkets. These kind of stocks, they give investors a fixed dividend. We also call them defensive stocks, not because they're into defense. Defensive stocks means these companies, they retain their value during recessionary conditions. So whenever recession comes, you may not buy an iPhone, but you will still buy probably Coca-Cola, right? So Coca-Cola is one of those companies, it will pay you fixed dividend, $3 at least 1 year. So if you buy 1,000 shares and you hold on to it for 1 year, you are paid a $3 dividend, 2.9 or $3 dividend per share. Does Amazon give you dividend? No. Why? Because the profit Amazon makes, they reinvest into technology. But Amazon grows in terms of the stock prices moves really wild. So you as an investor have a choice to make. Should I put my money into value or growth? Depends a lot on your risk appetite, because growth, tech companies are very risky. So please remember this, whenever inflation increases, investors ditch tech first, because tech does not give any dividend. So why should I keep this? If interest rates are going up due to higher inflation, why should I not buy a US government bond, earn a fixed income? Why should I take risk in a tech company? So tech falls first. In 2022, NASDAQ fell down by 40% due to higher interest rates, which was more than S&P 500. Why? Because tech. So you as an investor, you have to decide if you are closer to your retirement, if you do not have a source of income at this point of time, whatever money you have to earn, you have already earned, you have put money into bonds, which is giving you fixed income, you will be more inclined towards value, not towards growth. Because value means tomorrow if there is a recession also, at least you will earn a fixed income on that stock. And value stocks do not move too much. So Coca-Cola yearly movement, if you see 55, 65. 55, 65. You will see Tesla 250, 450. It's adventure. So you divide your portfolio between value versus growth. What tweak should be? So if you're a young person, 25, 30, 35 of age, I mean, you're young by heart, I get that, sorry. But I'm just saying in terms of you making money. Right? I mean, maybe you have retired early, maybe it's up to you. But the point is, if you're a student or if you are growing your career, more focused on growth, take that risk. Because if you lose that money, you have another 30, 40 years of you working and recovering that. But when you put more money into a riskier asset, you have a chance to make higher returns also, right? In this pyramid, you will earn fixed in a fixed deposit. You can earn a lot in a real estate, but more riskier, right? But more rewarding also. High risk gives a high return. But when I say high risk, I do not mean that put all your money, take a high leverage trade, and then just pray to God that it goes right. That is not high risk. That is crazy. That is just being crazy. That's all. So you have to take that chance for yourself. Second is energy transition sustainability. I think you have heard a lot about sustainability at this point of time. But here I'm just going to bring one thing in your attention. When I talk about sustainability or EV industry, electric vehicle, Tesla is not the only company. In fact, at this point of time, China is excelling in the export of EVs. So if you see companies like BYD, NIO, companies which are, so at this point of time, I'm sure even in here you have seen a lot of Chinese cars, right? So diversify in that sector. Also, when I talk about electric vehicles or sustainability, the companies which are manufacturing EVs are one, but the batteries which goes into those cars, where they get recycled, even there are companies for that, and those companies have stocks also. So if you think it's too late for me to invest in Tesla, you want to take exposure in EV, you can do it by that. Where does the electric vehicle gets charged? There has to be a company which is making charging stations. There are companies for that. Those stocks are also listed. So when you enter into a theme, don't stick to only one. That is where you again diversify your risk. If there is one theme of EV, get into more diversification, EV charging stations, recycled battery, even the battery packaging companies are there which package that battery and send it to it. So there are a lot of these industries which you can invest into. Emerging market growth, the best thing. I'm sure there are a lot of people who have invested into their own home country. great. While you continue to invest in your developed markets like US, UK, Europe, invest into emerging, Indonesia, Vietnam, Asia, every single. See, it does not matter whether you are aware about it or not. Learn more about it. Bring a consultant, pay the consultant, and learn about this. That is how the wealth is created. Because so today, South Korean markets fell down by 10%. Why we care? We care because we need to know that when there will be a sudden surge, maybe US market is overvalued, maybe the Korean markets are undervalued. I want to know what is the prospect. So keep your mind very open. This is one, I mean, I'm sure everybody has fair share of experience of profits and losses. And I think the best way to learn is to share more and more knowledge. So I'm sharing what I learned. I'm sure you have also learned by on your own way that what happens when you're not diversifying. So we are looking at all of these markets this time. We're looking at Asia Pacific. We're looking at Indian markets. I know that bull in India is still sleeping. It will, I am sure, wake up. But that is the best time when you invest. When markets are going down, that is the time when you invest. I meet sometimes people who say that this is not a good time. Markets are already down. Markets are down. This is a good time. You can, if you're a person who do a systematic investment plan, SIPs, what we call it, right? When markets are down, put more money and buy the index. Because you're not going to get this price very soon. When buyers will enter, pensioner funds, hedge funds, institutional buyers, banks, when they enter and the prices go up, at that point of time, you will realize that it was a good thing that you entered with more money. So timing the market is not in your hands. Each one of you could always, what is your ideal dream? Buying here, selling here. Amazing, right? What if you could? When markets were here, you would buy. When it reaches here, you would sell. What do we end up doing? Buying here. Buying more. Getting angry on ourselves. So much panic. Finally, sell it. And then market goes up and again we are crying like what has happened to me before you think I'm judging you. Happened to me so many times. I joined this company when I was 21. Now I'm 35. What do you think between 21 to 35 I did? No, lost. Lot of money. You're so young, what do you think? You're not thinking, right? You think there is whatever money is left in the market, today that money belongs to me. And I'm going to get that today. Doesn't work that way. So you have to understand that. So one of the biggest issues was that every time you lose money, you get out of the trade and you don't trade at all because you're so pissed off. You're pissed off because you took a risk which was uncalculated. So the best way is always stick with your trades, but wake up when you see that you wanted to make a profit of this much and you're holding to a loss of this much. That's not a good risk reward ratio, right? So we are looking at emerging markets. We are looking at high yield sectors, dividend paying stocks. So this year, please focus on quality companies, I would say. So I generally feel that because of these tariff threats and tariff fears, so there are two school of thoughts. I will share what has happened in 2016 when this happened. Markets went down and then markets recovered in spite of tariff threats because of Donald Trump. If you ask logic, I have no logic. This is what I have seen. Every single time, whenever the markets used to come down, it used to again go up. Now, does that mean we have to invest in tech fully? No. You invest into US stocks, invest into quality companies. So for those who want to do long term, there is an ETF called Vanguard S&P 500 ETF. The volatility is very less. If you want to do a SIP for your child's education or for your future, for your retirement, you need that money after 10, 15 years. There are two things. One is a US government bond, which will give you a fixed income, right? But the problem is that tomorrow, if the interest rates go up, you're still getting the same interest and probably it is not even covering the inflation rate, right? So it is a very safe investment, but the return is very low. you need something which can beat inflation in the coming year, right? So that is real estate, which we have established. Then, which is second one, stocks. You want to diversify in real estate. You will buy one here, one in Europe, one in Asia, one in. You need a lot of money for that, right? You want to buy stocks. You can buy European, German, UK, US stocks, which one share is $200, $300, $100. You can diversify more. So this is the year when you invest into quality, something which gives you dividend. And because of tariff threats, it is expected that inflation might go up. So you invest in those companies which can transfer the rising cost to the consumer. So if McDonald's make hamburgers, if the price of raw material increases, McDonald's should be able to pass that cost to the burger, to us, should not reduce their profitability. If they reduce their profitability, the prices would drop, revenue would come down, stock prices will fall. So it's time to invest into dividend companies, which gives you fixed income. Volatility should be less. Volatility should be less. Minimum risk, maximum profit only comes when you invest into diversified stocks. Plus when I started the session, I said more volatility, more opportunity. That is true. But you also have to manage volatility, right? So you don't put all your money into tech because, so Amazon 1 month ago was $230. Yesterday it was around 209. Right now, I'm assuming it is 214. You want that kind of action, you can have it. But don't surround yourself with only this. You need some subtle stocks like Coca-Cola, like Walmart, Johnson & Johnson. Something which gives you a fixed dividend, something which does not move too much every day. So in case if inflation was to increase and tech was supposed to fall, you can invest into these companies also. Again, how will I understand which is good, which is not? That is where we step in. You need a consultant. For all of you who think you have figured investments out, investment consultants, they are like doctors. You think you don't want one, but you might need one. Because when your portfolio is in a loss and when you're Googling what to do, that headache can show brain tumor. But when you go to the doctor, he will tell you that you're not eating right, just eat right for 3 days, you'll be okay. Our biggest problem is in short-term movement, we get panic, right? That is why you must have a consultant to talk to you. Yes, it has a cost, it has a charge. Pay that cost, pay that charge. Do not penny wise pound foolish. We're trying to save pennies while we are losing bigger amounts. Pay a professional and get their idea. I mean, obviously, even us consultants, we will never be able to tell you that, this is a stock which is going to go up 100%, never. But we're going to guide you to a direction that if you have no clue about how are Indonesian markets doing, how are South African markets doing. At this point of time, there are two kinds of crude oil which exist. One which comes from the North Sea, we call it Brent, right? One which comes from US, Canadian oil rigs, which is WTI. Do you know that the price difference between both the crude oils right now is around $4? That used to be around $10, which a month ago was $2. How do you take advantage of that? When the price difference is less, you expect it to go up. You buy the one which is expensive and you sell the one which is not. Because the one you sell, it is expected to go down. The one which you buy is expected to go up and the price difference increases. You make money over the price difference, which is a kind of statistical arbitrage also. Like this, there are a lot of strategies which you as a day trader can also put. Long-term investors who like to not trade every day, but want to take advantage of these opportunities, this is called strategy-based investing. It's not a new area of investing, but it got lost between long-term investment and day trading. This is something which you can apply to your portfolios and it has a logic to it. This is not something which comes on the charts and we put a call. So we'll share those strategies also with you. Meanwhile, digital assets and fintech evolution is one of those things. If Bitcoin does not make sense to you and cryptos feel too risky, there are a lot of ETFs which are related to Bitcoin and demand for those ETFs have actually increased a lot. So if you don't want to take a direct exposure in Bitcoin, you can take exposure in Bitcoin ETFs. While we're talking about Bitcoin, there was a question over here regarding Trump coin or basically cryptocurrencies. There are two ways you can buy a cryptocurrency. One is through wallets, right? There are a lot of companies which allow you to have a wallet. So the arrangement is when you buy a cryptocurrency, keep it in that wallet. The idea is that if it goes up, it is safe. So you want to transfer that crypto to another wallet, you can. It is just like a digital wallet. The only problem is those wallets can be hacked. At the same time, these companies are not regulated because cryptocurrencies are not regulated. It does not matter how many crypto digital asset conferences you go to, but bottom line, Bitcoin not regulated. You take withdrawal, a bigger amount in Emirates Islamic Bank, Emirates Islamic knock on your door. What is this? Where it is coming from? But this is not regulated. We close your account. Over. So you need to understand this thing, that when you are putting a bigger amount, I'm not talking about 5,000-10,000 dirhams. I'm assuming that's not something for banks to flag upon. But when you do a bigger transaction, 500,000 or 800,000, maybe you bought some Shiba coins, thinking I have 500 million Shiba coins. If it goes to 1, I will have $500 million. Where will you take the withdrawal for 500 million, if I may ask? Your Islamic accounts? No. You need to have an offshore account somewhere in New Jersey or British Virgin Islands or island of Comoros, right? Something which, if you zoom out from Google, you will not be able to see on the map also. Real, absolutely real. So the thing is, there are two ways to do it. One is called a CFD, which is a derivative. We call it contract for difference. Derivative basically means it's a replica, it's a mirrored product. So we see Bitcoin price is 90,000. The CFD providers, these online market makers, different companies, which I'm sure you have seen enough billboards. So these kind of companies, they provide you a replica of that product, which you can only speculate upon. You can buy or sell it. So you buy it at 90, it goes to 95, $5,000, you get the difference. You can't own that cryptocurrency. You cannot transfer it to someone else. You cannot have that in your wallet. That will always be in your investment accounts, paper trades. When you take withdrawal of those profits to your bank account, that money comes as a proceeds of investments account. Does not come as a cryptocurrency. The only thing is CFDs have a holding cost. So if you buy CFD of Bitcoin on a trading platform like ours or anyone else, we will charge you 30% a year holding cost. 1 year. If you buy today and sell it after 10 days, we charge you for 10 days. But there's a holding cost. That holding cost is not there in those wallets. But when they see the risk outweigh, because here when you're buying a CFD, you are able to buy and sell it with a click of a button. You can withdraw the money, withdrawal comes to your bank account, plus anybody who tries to hack your trading account and tries to withdraw that money, third-party withdrawals do not happen in these trading accounts because a lot of us are regulated. So we need a bank statement to validate that if the account was opened on the name of Mr. XYZ, the bank statement is of Mr. XYZ, so the money should come from where it came from. So even if someone hacked your account, tried to withdraw that money in his bank account, it's not possible. Unless they hacked your online bank account and then emails also and then send us the proof of, and we were not able to communicate, which is rarest of the rarest situation. In that case, you're very unlucky if that happens. I hope nothing happens, never happens to anyone, but much more safer way. So what you're asking in terms of regulation, crypto is not regulated. And as I understand, it may not be regulated for another few years because it is a very good instrument to speculate. Today, why you love cryptocurrency? Very few of them understand what it does. They just love because they feel it's going to go up, I'll make money over it. Right? Bitcoin has a technology behind it. If Bitcoin were used as a mode of payment, that would be the fastest cross-border currency transaction with minimum expense, right? That is something which you are not able to get right now in fiat currencies. Cardano is responsible for lifting up the education system of Ethiopia. Solana right now, so the Trump coin which is launched, it is launched on Solana blockchain. So if you, and Trump coin, by the way, is down 93% from its highest. So if you bought it at 70 or 60, my condolences. If you're planning to buy now, I would suggest instead of Trump coin, if you were to take that risk, Solana is a much better blockchain, has better proof of work, plus the Trump coin is launched on Solana blockchain. Solana is a sustainable form of cryptocurrency. So if you were to take that risk, Solana cost you $136 as of now, $140 one coin. So risk is less. So if you were to do it, you were to do it in there as compared to there. So even in cryptocurrencies, this is how you need to manage your risk. If so, that answers your question. If you have more questions, you can always take it further. Trading of CFDs require one understanding of concept, which is called leverage. Leverage means that you are able to buy more than your deposit. So just like if you have put $50,000 in your trading account and your broker is giving you 100 times leverage, that basically means you'll be able to buy 5 million worth products. 5 million. All you have to give is $50,000. Now that is the most aggressive you can be. We never recommend anyone to take a full 100 times leverage. What you can actually do is if you are putting $50,000 or $10,000, you could take a leverage of 2 or 3 times. Put stop losses if you are a day trader. If you are buying stocks, holding on to it, don't want to put a stop loss, okay. As long as your stock is of quality. It happens. Like if I have bought Coca-Cola, I'm going to give you that example. It's not really volatile. I have taken leverage on it. 3 times leverage, which means if the price goes up by 10%, I will make 30%. In terms of percentage profits, that's what leverage does to you. Today, if you have to buy a real estate, right? Most of the time, our mode is that we pay a down payment, rest we finance it from the bank. If you had cash with you, would you pay the cash and save the interest which you will pay to the bank for the next 20 years? I mean, it's a very open question, no right and wrong. How many of you actually would buy on cash real estate if you had the cash available? Which does not mean that I am assuming you have the cash. Just asking. So if you had the cash, say 2 million dirhams, you see a piece of real estate which is 2 million dirhams, you could pay the cash, not borrow from the bank, you would save it on interest. That is one school of thought. Second school of thought, pay a down payment, get money from the bank, you pay interest to them, installments, but the money which you did not invest, you could invest somewhere else, which could grow, pay the interest for the bank, plus earn more for you. That is what leverage is. So when you put money in your trading account, anything which you buy, it does not require you to pay the full amount for that. Just a percentage. That percentage is called margin. That is why a lot of these platforms are called margin-based trading, right? So while you are doing that, there is one more thing in CFDs which you can do, which is called short selling. Short selling means making money from the falling prices. So today, for example, if you feel that iPhone 17 is going to get launched, which will make iPhone 16 prices come down, you could borrow iPhone 16 from me now, sell it in the market, right? Get 5,000 dirhams, and then wait for the iPhone 17 to come. When 17 comes, iPhone 16 becomes 3,000. So you take that 5, buy it for 3, keep 2,000 with you, give back my iPhone 16. This happens with all the brokers. So it is available to you. So today, if you were thinking that stock markets could fall, you could short sell stocks. You could short sell commodities. But the only risk is that if prices start going up and you have not put a stop loss, then your loss could be unlimited. Because you know when you buy something, you know what is the maximum loss when you buy something? It goes to 0. You know your loss. But when you short sell something, you know your loss will be when the prices go up. Amazon was a $400 stock. Then it went to $3,500. Imagine someone short selling that stock every step it goes higher. Unlimited loss. So for a day trader, short selling is a very important tool because it allows you to make money from the falling markets also. It's very easy. It's not a new concept. And this is something which happens with a click of a button. You don't have to find a buyer and then borrow and then sell it. No, it happens with a click of a button and you can do it. But trading in CFDs, it really allows you to take leverage, which is one of the best things which you can do. Because when interest rates are low during that time, if you take 2 or 3 times leverage and the markets move up, your returns can be magnified. Goes down, losses are also magnified. That's why we always tell you diversify, put a stop loss, take less leverage. How many people I tell? 100% of them. How many people follow? 15% of them. 85% day traders lose money in the market. I want to know that, and I really wish just 15% of them are sitting here. Highly unlikely. But if you're not making money, that is not because of the markets. That is because of you. Somebody has to say out loud, right? If today you are making losses, that's not because of the markets. Markets are always going to be like this. It will never be. You look at the charts, RSIs, your technical studies, resistance supports. You have not counted in Donald Trump. You've not counted in a pandemic. You've not counted in Russia, Ukraine yet. Anything can happen. That is why you diversify as much as you can. So I'm going to show you now a few strategies. So there are different kinds of strategies, right? We're going to talk about, so entry exits. I'll look at the chart and I'll show you the entry exits, how we do it. And I'm also going to talk about the bond market also here. So as of now, because we are looking at a very high inflationary market coming forward. Again, a lot of what I'm saying depends on how much Trump actually goes through with the tariffs. If that really happens, then we might see inflation going up. That cannot be good for bonds. Because eventually, if that happens, we will see, so what happens when loans start getting expensive? Bond is a product which is a debt instrument. So I'm sure a lot of you know about bonds. Somebody who has not traded in bonds before, bond is what a bank does to you. So when you take a loan from the bank charges you interest, and then you repay the loan after whatever time period. Till the time you're using that money, you pay interest, right? So in case of bonds, you become the bank to someone else. You can actually give a loan to someone, and till the time they use your money, they will pay you a fixed interest. That interest will be in lines of what central bank has decided. Whom you're giving the loan to? US government. So you're buying a US government bond, you're lending them money, and if it's a 10-year bond, they're going to use your money for 10 years. For those 10 years, every year, they're going to pay you an interest. Right? So a lot of people, again, so now what do you have? You have bonds, you have stocks. Within stocks, you have value, you have growth. Then you have these cryptos. In cryptos, you have these ETFs, right? You're looking at gold, there is a direct commodity, and then there is a direct ETF also. So for those people who feel that gold is very volatile, you can invest into a fund which is buying physical gold, right? That way, your investment, what you are doing, it can be done in physical gold without actually owning the asset, first of all. And at the second time, when you're buying commodity, gold, it is very volatile. But a fund does not move in similar volatility as the actual price it does. Today, 1 ounce of gold is $3,000. But 1 unit of gold ETF could be $100 or $200. So you can still take the exposure. And if in 1 year gold prices go up, that fund which is holding physical gold, their value also goes up. So you get a less riskier way and still get the maximum benefit which you could earn by investing directly into a commodity. I talked about how silver prices in 2018 fell after the trade war happened. Surprisingly, this year, a lot of analysts have suggested, and you can obviously do your research, silver physical supply is much less than the demand which silver has. A lot of analysts have suggested this year could be the year for silver. And the price expectation increase is very high. So, if you were to take an exposure in silver, instead of investing directly into the commodity, you could actually look into silver ETFs. They're available. If you do not want to pay interest, buy a CFD, take leverage, there are ways that you can actually own the ETF, and that ETF would invest in silver. So it's actually like owning silver, except obviously you can't see or touch or make something out of it. But if silver prices would go up, you could earn money over that. Again, diversified. I'm just talking about diversification over here. It's not a recommendation. I mean, I don't want to read out a disclaimer real quick, so you are not able to hear it, but I'm sure that whatever I'm saying you right now, it's more about information. It's more about our understanding of the markets. Anybody who wants to do a live trade in the account, talk to a consultant first, then decide what to do with it. You ask me today, whatever I'm telling you is based on my own research at this particular hour. You leave this room, whatever happens after this in the next 1 hour, 2 hours, trends could work in my favor, it could go out in my favor. Because I want to show you the entry exit part, because this was something which was asked, right? That what is the, how the entry exit happens. And I'm also going to show you what's going on in last 10 days. So look at, okay, look at this. Look at gold right now. So we'll understand and we'll see that if I were to enter, how should I enter in the gold prices? Look at this price, 2912. This is $2,912 for 1 ounce of gold. 1 ounce, when I say it's called troy ounce, it's 31 grams. When you buy gold in Dubai, it is dirhams per gram. But when you buy in international market, it is dollar per ounce. So whenever you're going to buy, if you buy one unit is $2,912. If you see closely, it says L and H. H is highest of the day, 2930. L is the lowest, 2890, which means as we speak, it has already moved $40, right? 1 ounce, $40 movement, 10 ounce, $400, 100 ounce, $4,000, 1,000 ounce, let's face the reality, 10 ounce is enough, right? 100 ounce, if the moment I start talking about 100 and 1,000 ounces, I'm only trying to entice you to trade. So I'm not going to do that, because I know how crazy it will be if you buy 100 ounces. You won't be able to sleep in both ways, if it goes in your favor or against you. So 10 ounces quantity, fairly okay as per the risk, because if gold moves $30 to $40 a day and you are buying 10 units of gold, you could put a stop loss at 20. So that's $200 profit or loss. If you're putting a $50,000, $200 is a lower percentage loss for the day. Please calculate your profit or losses on percentage terms. There is something called a 1% rule, which is very popular. A lot of traders follow that. Should not be losing more than 1% of your total account value. If you put $10,000, should not lose more than $100 a day. Because reason is, why not? It should take 100 trades for you to lose $100 in every trade. So you lose entire $10,000. So 100 trades every day. So if you do 10 trades a day, 10 days, all 10 trades should go wrong. If that happens with you, never trade again. Clearly stars are not aligned there. It's not meant for you. But that's the most safest way, sir. Lowest risk. You're trying to earn maximum. So the best way will always be. Now we will look at, so first, this is for people who would like to enter on a very short term, day traders. Day traders, technical, there are 200 technical studies, more than 100 candlestick patterns. Nobody has the time or interest to learn that. Very few people take that interest, and I'm sure a lot of you would use that. Something which could work in your favor, just reduce the duration of the chart from 1 day to 30 minutes. And as a day trader, this is all you need. Look at this. You see this right here? Look at this. You see this big red drop which happened? It broke this right here. Right? This acted like a trampoline. Every time prices would come here, you bounce back. The moment it broke this, it went down. Again, it reached here, not able to break this, came down, and now it's here. Now, as a day trader, if the prices go to this direction right here, so if, let's say right now, if I zoom in, This is where the price is, 2913. If it reaches 2923, you must book your profits and get out of the trade. If it crosses this line right here, then this is where your next profit, 2946. You see these peaks right here, it touches there. What does it show? It shows there are so many sellers sitting right here. They start selling. Close your trade, book profit. So currently, if it crosses this level of 2930, your profit is 2946. Book your profit, comes back to 2930, you buy again. Keep doing this until this support breaks down, which means your stop loss should get hit and you should be out. Day trading is about probability. So your entry and exit should never be random. You woke up in the morning, you saw outside, it is cloudy day, today is going to rain, let's buy gold. No, don't do that. Because what we go through is something called FOMO. If something has already gone up too fast, now you're thinking, shit, I did not enter. I must enter now. Let's see what happens. But what happens? By that time, it has already gone up. Now people are booking profits, so it starts coming down. Same thing. You're getting panicked, comes down, you're crying, angry, and then you sell at the lowest, and then market moves higher. You only enter where there are buyers and sellers sitting. Sometimes it will be okay to not trade. As I said, always look at your loss in percentage terms, profit in percentage terms. Sometimes I meet people, they say that, see, I want not much. I'm putting $50,000 account. If I'm able to make $1,000 every month, I'll be okay with it. $1,000 every month, it's okay, 2%, okay, fine, 25% a year. Fair enough. Somebody would say the same thing when they put $10,000. $10,000, I'm going to put $1,000 if I'm able to make that is okay, it will cover my travel cost. $1,000 at 10% profit in a month, 120% in a year. If I'm able to bring that for you, why should I do it for you? Should do it for myself. It's not real. The only way it would happen if you get lucky in a trade, which I'm sure at some point of time you must have tasted it. But to be consistent with that, it's not. That's why we diversify, right? That's why you put some money into with stocks. You could be that lucky actually, because when you're investing in a trend which is related to cybersecurity, DNA sequencing, remote medical consultation, 3D printing, drone manufacturing, see the kind of things which I just said. Now, when you're thinking about it, like this sounds like a very good idea, but I'm not invested in this. There are companies to it. I'm going to show you a portfolio which is called high beta portfolio. This is a bunch of companies which are in a section which is high risk here, but every company is related to a division. Coming to entry and exit. Now, you're looking at gold right now. Let's see the same thing when we are looking at, let's say, a stock market index. Okay, so I'm going to look at US 500. So this is S&P 500 right now. One unit of S&P 500 is $6,000. So today, if even you wanted to buy 500 or $1,000 worth S&P 500, you can buy point units of that. Anybody who wants to do a SIP, a lot of people do SIP. SIP is a systematic investment plan. So what you do is, in a very disciplined manner, with very less risk, you dedicate an amount which you are going to buy S&P every month on a fixed date. $500 on 15th of every month, I'm going to buy S&P. Markets are going up, I'm still going to buy. But if the markets come down, I will buy more. That is going to be my idea. You do this for 1 year, 2 years, 5 years, and you will see the results of compounding in it. And that is the best way to invest long term. So there was a certain survey done where we realized that from 1990 till 2023, if you have been invested, not taking your money out from S&P 500, an X amount of return was generated. But if you missed out 30 best trading days, your return would come down from that return by 83%. Just imagine 30 years, but if you were out from the market for 30 best trading days, you took your money out or you were waiting, you cashed it out, you must have lost 83% of that return. That is the power of being invested. So every time when you think that this is the time I want to keep my money in my pocket, not invest. Every time you keep your money outside and not invest in the market, it loses its value. It's just a myth that stock markets are risky. Sorry, that's not a myth. It's myth that you always make a loss in stock market. Stock markets, you don't always make a loss. Because what you are losing in? How many of you have an iPhone today? Anyone has an iPhone? Anybody uses Microsoft? Email, PowerPoint, Outlook? Anybody has Netflix account? You wear Adidas, Nike, Skechers, you drive a Toyota, eat McDonald's, KFC, drink Coca-Cola. Buying these products, enjoying them, investing in those companies? No. Why? Because stock markets are risky. You buy an iPhone today, it's 4,000 dirhams. You buy Apple stock today, after 1 year, iPhone value is going down. But stock is up. You can buy iPhone 17 with that, maybe 2 of them. Stock versus stuff, very basic thing. Should I buy the stock? Should I buy the stuff? Can buy Louis Vuitton handbag, could buy Louis Vuitton stock, which will go up if someone would have bought Louis Vuitton handbag. So think about it. Stock versus stuff is a very popular opinion. I mean, obviously buying stuff gives you mental peace. You're happy about it. Buying stock, it gives you a way to invest in that company. So as of now, when you take deliveries from Amazon and they charge you extra for delivering before the time, you could invest in that stock and make money out of it, right? And look at US stock market index right now. Look at this chart right here. See the pattern, okay? Now again, I'm going to reduce it to a very smaller duration, right? We are looking at last 10 days. And if you see this, you see, for the longest time, buying would have been very easily anticipated here. And then look here. Look at this. You're buying an entity. The moment it broke this, it came down here, bounced back, and again came down here. Even a major fall which happens, it stops at the point where there are buyers. Look, here, 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 here. Look where the buyers are. Now you tell me, if you spread your money into 10 different products and enter and exit at these points, not when you want to, what is the probability of you losing your entire capital, which you hear a lot of time from people, right? I lost my entire money in day trading. You cannot lose your entire money in day trading unless you are very much focused to lose all your money in day trading. You know when to stop. You have the power. Nobody's trading on your behalf. You have the click, right? Where do you stop? You don't stop. Because when you enter into a trade, you don't put a stop loss, starts going down, break this line, goes down further. Now you don't know what to do. So you're under panic. Only enter and exit. Look at a 30-minute chart. I am telling you today, take a demo account. So all of you who have take out time to come here, all of you will receive a demo account which will have all these products live in the market. Prices are real, money is not. I'm repeating myself again, so you don't have any confusion before you ask withdrawals from me. Prices are real, money is not. So you could buy, sell this, and I'm going to tell you which products you should be looking at. So from metals perspective, gold, silver, enough. From oil perspective, so energy perspective, crude oils, this is what I wanted to show you. Look at this strategy right here. This is what you must know. The price difference 2 months ago, it was around $2.2 between two oils. Past year, it went to 1.9. It was expected to go around $4. This flyer was done somewhere around 21st Jan 2025. And now if you see the price difference between both, it has already reached to 4. How do you execute this trade? If you feel that the price difference is less and it is going to increase, you buy the oil which is expensive, which is the Brent oil, the UK oil, and you short sell WTI. The idea is that either one will go down or other will go up, but you will not make money from oil prices moving. You will only make money when the price difference increases, right? That price difference, imagine if it is $1. For the longest years, Do you know this is not something which we are tracking? So if anytime when you Google something called Brent WTI spread, and you will see this chart, and you will get to know that this is something which has been tracked for years. Look at this. So if you see last 3 years, you see the price difference, how low it has been? 80 cents, right? Look how high it has been. $9 to $11. What is it right now? $4. What it was a month ago? $2. Somewhere around here, right? See, right now it is 4.25. Look here, it was in January, 2.08, moved up. As a day trader, if you take a trade in oil, one-sided trade, either it will go up or come down. If you're buy, it goes up, you make money. But if it goes down, you lose. When you do this trade, you're not worried about where the oil market will go. You're just worried about the price difference increasing. In this, when you can lose your money, if the price difference comes down further than $2, well, if you see the historic, it has gone 30 cents. It has gone minus $5 once during the pandemic. The same time, it has gone $54 up again during the pandemic. But that is, of course, abnormal. But on an average, peaks have been around $10, $11. Bottoms have been around $1.5 or $2. You get an entry at $2, that is the risk which you should be willing to take. Take 500 barrels, $2. Even if the spread goes to zero, what you lose is 1,000. But the chances of that happening, again, investments are about probabilities. You calculate your risk. We will never say that it can never happen. Anything can happen. But imagine taking a trade which is 50-50 versus a strategy-based trade. And this is for all those people who do not have time to place trades every day, who have not much knowledge about charts or day trading, or who don't want to involve yourself. You wait for opportunities like this. Right now it is $4, so we will not tell you to do this right now. But if it was to come down again to 1 or 2, that could be a brilliant opportunity. These are the products which are available to you on any platform. You take this flyer home, whichever broker you use, you trade with that. That's your responsibility. In our case, this is something which the consultants make. These strategies, by the way, we put it on our websites and everywhere. But if you go to anyone else, these strategies are not out there. Nobody does that. Why? Because the popular concept, as I said, has lost between day trading to long-term investing. There's a big window between that. That window is called strategies. So I talked about price action analysis, how you can take advantage of earnings, right? We have that flyer where you can get a statistics about that how the earnings have been for a company. So if you were to buy the stock, hold it for a day, for a week, or for a month, how much profit or loss maximum you could experience, and what could be the volatility in that stock. So maybe for 2 months, you are not the kind of person who's trading, but that month of earnings, we can present you with opportunities. Let's see, these are the 100 stocks which are going to come. Out of this, these 15 have probability of going up, out of which these 6 of them have less volatility. Why don't you try it out? It's up to you. It's absolutely up to you. But from our end, we want to give you that idea. We want to give you that consultants also. Look at this portfolio. This is something which has been recently made. This, before I even talk about this, this is something for those people who can take slightly higher risk. These are not the kind of stocks which gives you any dividends. High beta, high alpha play on futuristic themes. High beta means these companies are very sensitive to the stock market. So if stocks would fall down by 1%, the stock in that index could probably fall down by 3%, right? So they're more volatile than the index, no doubt. Higher alpha means you could achieve higher returns also. Now the concept is very simple. We are looking at these futuristic themes. So look at these stocks: Intellia Therapeutics, Transmedics, IonQ, New Holdings, eHank, Archer Aviation. Look at these sectors: biotech, healthcare, technology, hardware, banks, aerospace defense, electrical equipment, machinery, healthcare, and biotechnology. These portfolios will definitely be sent to you, but just look at the one reason why we are putting it. So high beta investments, futuristic, higher growth, strong return potential, but highly volatile, very sensitive to market fluctuations. This is a make it or break it kind of a situation. But when you look into the stocks further and you will see, look at this stock. There is something called gene therapy or DNA sequencing. There's a technology called CRISPR technology, which a lot of companies which are into this area have been using. This is one of those companies which have been using CRISPR technology. They have a lot of proto trials which are in the clinical stages. And if you see, a lot of their trials have shown positive results. Something with therapeutic companies which you must understand, they have a lot of these prototypes in trials, right? When you will see their fundamentals, the compounded revenue growth will come minus 10%, minus 20%, because they don't have a revenue stream. But if one of those trials which are in the later stages, when it gets approved, $1 billion revenue stream could increase and these stocks could go up. So that is why high risk, high return kind of the companies. Would you put all your savings into this? No. A percentage, while you have already invested into your real estates and your saving accounts, in your growth stocks, value stocks, in your bonds, and then you are doing your strategies, a small portion goes to a mixture of this stock, not only into one company. There are 10 of them, and all 10 of them, if you see, look at Transmedics Corp, again, a med tech company, medical technology. OCS is the first and only commercialized Food and Drug Administration approved medical device for heart, lung, and liver transplantation. A lot of these companies have become better, but if you see the same thing in 2019 or 2020, when we will read the fundamentals, it would come across negative growth. But the moment their trials got approved, now these companies are doing really well. So these are futuristic themes. Again, it's a mix of portfolio. You can look into it. We have added a lot of fundamentals into it before we have put into. This is absolutely based on research, guys. There is the possibility that maybe you picked one or two out of them, they went down, went in a loss. So it's definitely your risk. I'm just giving you an idea that if you were making a portfolio, a small portion can go into futuristic themes also. See, DNA sequencing years ago, it would take 10 years and more than $1 million to sequence a DNA. Now, this is something which can be done in $600. It takes 3 hours to do it. So there are a lot of these companies which are coming into this area, which you can definitely look into. So this is one kind of a portfolio you can look at. Another thing which we have seen, something which is called a pair trade. Pair trade is again a different strategy. This is about, so what you did in Brent and WTI, right? UK and US oil. The same thing you can do it in an index. Right now, what you see as a day trader, you buy an index or sell an index. But this time, what you can do is look at two indices. One of them, which is a small cap index, another is NASDAQ. We look at the fundamental, we see that if in the future inflation comes under control and the rate starts coming down, the small cap index is one of those index where most of the companies, they have variable debts. Variable debts means they will pay less interest if the interest rates are supposed to come down. So if at any point of time the tariff threats go off and Trump starts again reducing tariffs, inflation starts coming down, central bank again start cutting rates, small cap will be the first index to skyrocket. So versus small cap versus NASDAQ, you say that you buy small cap, you short sell NASDAQ. Again, that is a play on two different indices. So guys, these kind of things, again, this can be put in your portfolios, but you have to sit and understand. Again, we have a very limited time. I'm sure after this, once you go home, you will have absolutely no interest in looking at this. So what we are going to do is send these PDFs to you. Plus, after the session is over, anybody wants to have a one-on-one session tomorrow or later, absolutely, please come, whether you are a client or not, come and learn. That's all. There's no commitment to it. You don't need to open an account, put $200, and then we'll tell you no. This is knowledge. If I was able to give 100% return, I would charge you for every session. But I know this is equally risky. So my job is to just keep you aware about these things. So these sessions can be done as and when you require. And we can definitely give you a one-on-one session for that also. If you have any questions, please, any questions if you have, do ask. even if not related to this, if you have any questions of your own regarding trading or investments.
When WTA is it like is it like 1 year to buy and 1 year to sell?
Yes. So if you see on this platform, real quick, so this is, if you're looking at Brent WTI right now, this is in commodities. See, this is 72.75, and then if you see WTI, $69.03, right? So if you see the difference right now, obviously Brent is expensive than WTI. So the idea is you buy Brent, sell WTI if you're expecting the price difference will go up. But if it is already 4, you're expecting it will come down to 2, which a lot of clients actually don't do it because they prefer that when the difference reduces, then enter. Yes, if the difference were to increase to 11 or 12, that is when you short sell Brent, buy WTI. Expect this to go up, this to come down. And this is to be done with equal quantities. 1,000 barrels buy, 1,000 barrels sell. But you open this trade together, close it together. Never try to, so the unpopular thing which happens, buy one, short sell, the one which is in profit, they close it and then wait for the one which is in loss to get in. That's again speculation. That is not strategy. So we tell you exactly how to do it. Except clicking on your behalf, we will be able to explain the strategy completely to you. If you want, you can try in the demo accounts first before you even try anything in your live accounts. That's something which I want to really focus upon. So whatever you're learning here, it is really important that first you try in your demo account, and then when you feel that you have seen the spectrum of how high or low it can go, only then you move forward into it.
Actually, is it like every day we can see it around 4%?
Easily. It moves a lot. Yeah.
Is it
Available with the pair?
natural or is it like something?
No, natural gas is the same fuel which you see and moves a lot. Sometimes, by the way, so one thing which you need to know about natural gas, it's a very important thing. A lot of you, if you have not looked at natural gas before, the holding cost in natural gas changes. And if you see here, even today it has gone down by 4%. Look at this. If you buy natural gas, as of now, you will receive 100% in a year swap in your account. A lot of CFD brokers, they do not charge holding cost. So they do not give you the swap also. Today, right now, as you see, you will, if you buy natural gas, you will receive 100% over the year. This is something which gets credited to your account. It is called a swap. Now this swap will change month on month. So if you divide this cost by 12, for 1 month, definitely that money comes to your account. So sometimes, let's say, this is 100% a year, maybe say 10% a month. If you buy natural gas now, you lose 10% if the prices drop. If you hold it for a month, at least 10% will come back to your account. So you can take, sometimes we used to pair it with oil, buy one and short sell oil, and we would get holding cost in both of them. So there are a lot of paired rates which we can provide it to you. So again, some strategies which I'm sure some of you have done trading, some of you not, but there's a wide spectrum of you can learn, anything you can learn. None of these strategies, like none of you require a CFA or a certificate to understand this thing. So that is something which is a very basic thing. I have people from 20 to 70 who do all kinds of investment. I have made people sit who did not know how to use the laptop. They are trading right now at their own understanding. Century gives as much time as you want to learning. We are happy to provide. There is no charge to it. There is no fees to it. Client or no client, we have this big facility. Give us the time, come every day, sit with us, look at the markets, enjoy your demo account. After that, you feel you don't want to do it, do not do it. In our case, we are very happy to educate. Just come and learn. I think this is something which we really want to encourage.